And this report here, options volume report, shows all the different stock symbols that have options trading. And it is sorted right now by the column that shows the total notional dollar value of all the options traded. So NVIDIA, you can see, made the top of the list, traded $3.19 billion worth of options. And next to it, we see on a daily average, it trades about 2.67 billion if we use the last 90 days. So if we look at that ratio, that's 1.2 times its average daily volume. And down here, we also have a breakdown how many contracts traded that were single leg, either call or put, how many were involved in a multi-leg trade and contingent. So I think we did NVIDIA the other day. So let's slide down maybe. Let's take a look at, here's one, SMCI. That doesn't usually pop up here. So you could see here, yesterday traded $718 million of options in dollar value versus around 500 million on average, and that's 1.4 times its daily average. And 82% of the volume yesterday were in single leg trades. I'm just going to pick that one out, and it just kind of hit my eye because it was up 15% yesterday. So let's just take a look at what happened in those single leg trades. I'm going to pop in SMCI in a new window. And what we're doing here is sectioning off, keep in mind, not all the options trades, but just those that were single leg option trades. So let's go to SMCI here. And under the options, we're going to bring up this single leg dashboard. And this will give us different metrics and analytics of what happened yesterday. And the idea here is, first, we want to try to figure out what are people doing and why. Then we're going to ask, well, how is it impacting the markets? And is there a trading opportunity? Okay, so with the volume and the price change here, to figure out the why part, why are people trading here? Why is it up? Why is there an unusual volume? Really, for that, we'd have to go and research any surrounding news. Maybe there's activity because there's an upcoming event. I see one right here, May 20th, there's an upcoming event. So I'm not going to do that part here. I'm going to leave that up to you because that could take a while, and I'm not going to sit here reading news or things on Twitter or researching the upcoming events. But let's say we already did that, and then next question is, okay, so what are people doing here? And we're going to analyze just single leg options trades here, which yesterday there are 268,252 option contracts that were tagged as single leg trades according to the Oprah feed. Okay, that's how they got reported. And that's out of total of 328,000. Now the breakdown is, the calls versus the puts, because there could have been calls, there could have been puts. So we see here 62% of those trades were in the calls, 38% in the puts. So definitely a lot more trading in the call options. Then let's take a look at how do we think the order flow is coming in general. Was it overwhelmingly the end users coming in with buy orders, sell orders? And we have to make an interpretation using the surrounding data. That could be a whole webinar on its own, but according to the methodology we're using, we see 52% of the incoming orders appear to be coming in from the buy side, 48% on the sell side. So slightly more on the buy side, but it's somewhat balanced as far as number of contracts. Then let's take a look at the execution. And right now we're trying to paint a picture of what are people doing, how are they using these options? Okay, we're trying to prepare ourselves. Well, how are these options once they're, because what happens is, you go from the broker, you enter in your orders, then they flow down to the centralized exchanges. But how are they getting executed at the end? And that could be different ways that it could get executed. So let's take a look at that. And here we have a breakdown. So 73% of them were auto executions. And that means that those trades came in electronically. They were matched up with the exchanges matching engines electronically. And that represented 73% of the trades. Then 22% of those that were entered in electronically, that hit the exchange's price improvement auction mechanism. And what that does is it stops an order that's marketable. So you could enter in a marketable order or a limit order that's away from the market, right? So if you enter in a marketable order, meaning that this order, you're trying to buy it on the offer, sell it on a bid, or close to it, that it looks like this is eligible for an immediate execution. Well, the exchange can put it through a process for price improvement that before it executes the order or before it posts it, it flashes that order internally to its market makers, its specialist. And if you have a lot of market makers, they may compete for that order. So the idea there is, hey, here's an order from a customer willing to buy this option for $1. Would you be willing to sell it to them for a better price than $1 and give them a price improvement? Well, some market makers might say, hey, you know what? I want to sell this option. I have it worth 90 cents. I'm willing to sell it 95. Some say 94, some 96. So if there's a price improvement, then what happens? It'll get executed at a price that was favorable to that customer. So instead of, if you put in a limit order for $1 and then all of a sudden you're like, oh, I got 98 cents or 95 cents, then you paid less. And we could see here how often that happened. 22% of the volume, meaning that there's hidden liquidity out there beyond what's displayed. Okay, that's the idea, that even though we're looking at these displayed bids and offers, there are dealers and they're willing to negotiate even at better prices than what we're seeing. Okay, so we have to keep that in mind as we're building up, up to potentially entering orders or making a trade. What about those aggressive order types? Those intermarket sweeps, that was 4%. So what does that mean? Well, an intermarket sweep is a special designation that the customer would have had to mark his order as an intermarket sweep. Okay, so that's before it's not a regular limit order. You would have to actually select that an intermarket sweep order. You have to opt into it. It's not the same thing as a price improvement, where you're saying, I want to ensure that I get filled, and I want to bypass the exchanges, trade through the trade through rule. Okay, and what the idea there is that if you have a certain amount of options that you want to buy and you see that the different exchanges, they have maybe slightly different prices. Some exchanges have a little bit better, some a little bit worse, but you don't want to go to each exchange in order of how they displayed it, because the market can move against you, right? So let's say one of the exchanges, CBOE, has the best offer, then the next best offer is the Amex, then Philex, and you would, the way right now, if you enter in a regular order, it would have to go to the exchange with the best offer first, CBO. If there's no more left, then it goes to the Philex, then it will go to the ARCA. But that routing will take some time, and the stocks could move, and those offers can move as well. So an intermarket sweep order is saying go to all three simultaneously. Take the, I don't care that one price is worse than the other, because there's not enough displayed size on that exchange anyway, that I'm gonna end up having to go there and to all three. So go simultaneously, to all three. That's an intermarket sweep. So what sometimes you'll see, and as we'll see, is that you'll see a trade through when an intermarket sweep comes in. A trade through will be, well, there is $1.10 offer, but I see it trade at $1.15. Well, that's because an intermarket sweep could go get the $1.15 first and then the $1.10. Okay. So that happened 4% of the time. And yesterday we didn't see anything on the floor trades or anything significant that would break even 1%. Okay. So in the floor trades, that's where those are human touch trades that you use a broker to call and try to negotiate or try to find other people willing to trade with you at a better price or structure, and that would be more human touch. Here, what we do is compare the trade to the state of the market at the time of the trade. Okay, so where did the trade occur? And we could see it's 22% on the bid, 23% on the ask. So that's kind of evenly distributed there. If we look at what about, some price improvements there where it didn't trade in the midpoint, but it traded closer to the bid, but not on the bid, or closer to the ask, not on the ask. So that was 24% closer to the bid, 26% closer to the ask, and then nothing below or above, below the bid or above, so those intermarket sweep orders didn't really trade through. And then we had 4% right at mid. So very little right at mid, so only 4%. Looks like, that you'd to get a fill, it looks like you'd have to go somewhere, either above or below the mid, but a decent amount we're getting price improvements, okay, the beyond what they even enter. So that kind of gives us the liquidity of how things were trading yesterday. Okay, so I'm gonna keep coming down. I don't think I got to this part yesterday, so I'm going to try to go a little bit quicker. Here, we list these aren't the most, these are 5 large individual trades. Okay, so this isn't all the volume on this contract, is just looking at an individual trade. And the idea there is, let's list the top 5 big trades and see if there's some kind of a trend or pattern there. Okay, just in the top 5. So I'm looking at the top 5 here. We got May 17th, 920 put, 400 of those puts traded $11, and we interpret it as a sold. We got June 1500 call, 350 traded there, 553. We tagged it as a sold. May 17th, 880 put, 313 traded at $4. We tagged it as a sold, and so on. So just eyeballing these, I'm looking at the first thing, the option. The only thing that I see a commonality is that they're all May 17th. Okay, that's the first thing. And most of them look to me like out of the money puts. So here's we're at 952. I don't know where the stock moved around, but most of them look to me like puts, 2 sold, 1 bought. 4 of these trades were in May 17th, and it looks like most of them were on the sell side, and they look, that they're dispersed. The only one that kind of didn't fit into that is the June 1500 call, which was an upside call, looked like a sold. Okay, so not if I just had to eyeball it there, it looks like maybe the front month options look like some of the bigger trades were coming in from the sell side that were strikes away from the spot. Here's the breakdown by delta. So at the time of the trade, 35% of the volume were at the money calls. So by far, at the money calls were the most popular options that were trading yesterday. And next is the puts, 16%. So you could see way more calls than puts trading at the money. So those were more popular. In the money, 4% were calls. We don't see any in the puts. The wings, 13% were calls, 9% were puts. So the wings would be something that is a little bit further away from at the monies, 25 deltas. But we separate the wings and the tails. The tails would be 5 delta and below. So you could see here the tails, the very far out. So the tails would be something that are cheaper or don't have as much delta and gamma, but they're far away. So those would be like gap risks or very big, anticipating very big moves. So on the tail side and the wing side, we're close here in the distribution of volume. Moving on, I'm going to go a little bit quicker. This is the breakdown by trade size. So very small retail trades, about 33%. Those are retail trades, 33%. The very small trades, almost 40%, 39%. And then we got large trades, 12%. And then trades from where we call proficient traders, 16%. So that's the distribution of volume based on if we bucketed them into trader size. This here, volume by exchange, lets us know if there's any particular exchange or group of exchanges where the volume is concentrated. And that allows us to kind of see where the liquidity is, where the price improvements might be, where maybe we wanted to direct our orders to get better executions. Okay, that's where the volume exchanged. Now I'm going to scroll down here really quickly. We don't have that much time. So that's kind of giving us an idea of what people might be doing and how they're using those single leg options. Here, now we combine them with the volume and how is it impacting the option prices. So here we see graphically that May 17th received the bulk of the volume, right? 120,000 traded in the calls May 17th, 74,000 in the puts. Okay, then the next month is May 24th, May 31st. So you see the distribution of volume by these bars. Then what we plot is what the implied volatility looks like in these options. So now we could see the term structure where, and then we see a gray line of what those same strikes were yesterday. So we're looking at, give me that, the money strike, and show me what the implied volatility of that strike was yesterday. So we could see the changes. So May 17th, it's noticeable. You see this red dot, that implied volatility declined, right, from the day before. But if we go out further, May 24th, and the term structure shifted higher across the board. So that's the difference, that yes, that looks like in May, there where most of the options were, the implied volatility decreased, but as we go out further, it looks like the implied volatility increased. And something, look at how the implied volatility curve looks like. That something is expected to happen by May 24th expiration, because that is an inverted term structure, right? That the nearer term implied volatility is way higher than the longer term, meaning something is telling us something is expected to happen around that expiration. Earnings, maybe some kind of an event. So we'll have to go, in here we do log that there's going to be an event coming up May 24th, company event. You could see here May 20th, company event. So this is how the options are getting impacted. All right. May 17th, we're selling, and it looks like sellers of options, outer months, there is a big increase. So here is the breakdown in the table. So in the table, we see by expiration, we see the events coming up, we see the implied volatility at the money, we see the skew. So here's an interesting thing here, that the skew across the board looks like it is sloping up as we go up and sloping down as we go down. Okay, let's see how that looks like in May 24th expiration. So I'm going to click on the May 24th expiration. So this is 15% of the volume yesterday, May 24th. And look how this is by strike. These are all the different strikes here. This is the volume by strike, the calls, the puts. But you could see here, as we are increasing in strikes, the implied volatilities are going up, right? We could expand this chart. Okay, and this is how it yesterday looked. This is yesterday's, and this is, I'm sorry, the previous day versus the next day. You'd see the whole thing shifted up, especially skewed to the upside. You see that slope going up? And you could see here lots of calls trading out here, indicating that lots of call buyers, right, pushing these up, or at least the demand for this is going up. You can see most of the volume right here, 900 strike. If we hover over, we'll get the volume and the VWAP price. So even here, let's say 1200, I'm going to hover over that. On the 1200 strike, what do we see? 763 contracts traded in the calls with an average price of $4.39. So some decent premium going out there. That's 20% away or 30% away. So I'm going to stop right here, Will, because we're already past 9:31, but we'll continue on analyzing these single leg trades.
That's awesome, D. Great job, my friend.
All right. Thanks, everyone. Thanks for joining. Stay safe out there and have a great trading day.
Trade in peace, Chameleons.